Let's turn to today's big number, $25 billion. That's how much Amazon's looking to raise in its latest US bond sale. According to sources, the offering could ultimately grow even larger depending on investor demand. The sale comes as Amazon ramps up spending on AI infrastructure. The company's marketing debt in as many as 8 tranches with proceeds intended for general corporate purposes, including debt repayment, acquisitions, and capital expenditures. Bloomberg Intelligence says the company's capex is likely to top its current $200 billion guidance for this year, and next year could approach $300 billion as demand for AI continues to outpace supply. Robert Schiffman of Bloomberg Intelligence here with the react. Now, capital expenditures can also go up because it's more expensive to do things, right? You build a data center, you have construction labor inflation, as we talked about through the show, memory price inflation, but you're specifically looking at the weighted cost of capital, why the corporate bond market works well, and now you're looking at the pro forma cash amount. Give me your thesis.
Well, first of all, $25 billion, it's not that big of a number.
Right.
You know, these guys have already...
Well, we just said it was the big number, Robert.
Well, it's getting bigger.
Okay.
And it's probably going to be more
That's
than
why I asked you about the pro forma cash.
They have raised almost $70 billion across currencies this year already.
Right.
And their cash number is up above $150 billion. This clearly implies that spending is going up. It's going up for a variety of reasons. One, the cost of everything that they're buying is going up. Two is the amount of stuff they need to buy is also going up, and they are trying to front load as much as they can. Three, they're also making investments in others like OpenAI and Anthropic, and they're feeding the ecosystem similar to what NVIDIA is doing. So I don't think we should be surprised by these numbers, and I just think they're going to keep getting bigger and bigger.
You know, bondholders and Amazon bondholders happy to be one, right? I get that. Corporate credit is not my strongest suit. All I can do is look at what Andy Jassy said at the last earnings call. Capital expenditure growth outpaces revenue growth until such time that the thing you've actually deployed the capex on does something for you in return. You build a data center, and until it runs workloads, it doesn't generate revenue. They're trying to manage that.
Yeah.
You think they're doing a good job?
I actually think they are. I think investors need to be patient. It's historically not a patient market, whether a bond market or stock market. But the amount of spending that you're going to see over the next couple of years is going to far exceed the amount of cash that's coming in. So people are going to constantly question whether or not there's ever going to be a return. And quite frankly, even if you see very, very strong cloud numbers, or if you see some AI monetization, it's still on a relative scale. It's not going to be anywhere close to what their capital spending is. So what has to happen? I think bond market has to hold up, right? Yields can't go through the roof. They need to have access to cheap, low-cost capital. They do, and they're taking down as much of that as they can. They need to show that they're monetizing and continuing to show, really strong double-digit growth across their AI and cloud businesses. And then 3, they need to continue to convince the rating agencies that none of this matters.
So let me ask you this to end. We just have 15 seconds. Why is Amazon the creme de la creme of issuers?
Well, because of all the debt that they've issued, leverage is still really low. It's well below this 2.5 times target that the rating agencies have. So they have room to borrow a lot more, and they generate a ton of cash flow from their other core profitable businesses. And they can help finance long-term growth with short-term borrowing.
Robert Schiffman of Bloomberg Intelligence, thank you very much. Let's go back to the equity